Welcome to The Explainer. So today we're going to look at healthcare organizations in a slightly different way. I want you to imagine your clinic, your hospital, or your practice as a patient, right? Just like our human patients, an organization has a comprehensive health profile. Those financial statements sitting on your desk, those are basically your patient's vital signs. And capital budgeting? Well, that's the long-term treatment plan to ensure a long, healthy life. Let's dive in.
Here's a dilemma that healthcare leaders face literally every single day. Let's say you want to expand. You're looking to buy a brand new clinic, or maybe you want to invest in some incredibly expensive, state-of-the-art MRI machinery. The big question is this actually a good investment? How do you, as a healthcare professional, step back and make these massive, multi-million-dollar strategic decisions without jeopardizing the entire organization?
Well, that is exactly what we're going to figure out today. Here's our roadmap. We'll cover healthcare accounting basics, the 3 financial statements, the time value of money, evaluating investments effectively, and finally, the capital budgeting process. By the end of this, you might just want to change careers from a nurse practitioner to a finance major. Kidding, but let's master the essentials.
All right, starting off with Section 1, Healthcare Accounting Basics. Let's look at the foundational anatomy.
Before we can diagnose our financial patient, we really have to understand its baseline anatomy, and that foundation is built on GAAP. That stands for Generally Accepted Accounting Principles. Healthcare organizations use GAAP for all their financial reporting. Now, it's not a strict written law, but rather this evolving set of established industry standards. Think of GAAP as the universal language, or, going back to our analogy, the standardized vital signs monitor that ensures everyone is reading the patient's health in the exact same way. And at the very heart of this language is the basic equation of accounting. Assets equals liabilities plus owner's equity. It's actually wonderfully simple when you break it down. Assets? Those are the total resources the organization owns. Liabilities are what you owe, the borrowed capital you use to get those assets. Now, a quick caveat. In the healthcare world, especially for nonprofit entities, owner's equity is usually just called net assets. It's literally just the total value remaining after you account for all those liabilities.
Moving right along to Section 2, the 3 financial statements. These are your 3 crucial reports.
Okay, so now that we have our equation, we need a way to actually present this fiscal information. Now, what's really interesting here is the critical difference in timing between these primary reports. The balance sheet gives you a static snapshot of the organization's position at a highly specific point in time. It's like a photograph. The income statement, on the other hand, is much more like a video. It actively tracks your income, your expenses, and your profits over a period of time.
Let's look at a real-world balance sheet. Notice how it meticulously outlines exactly what the organization owns and owes on a specific date. This document is absolutely crucial, guys, because it directly impacts your credit rating. It dictates your ability to borrow additional funds for those massive capital projects we talked about earlier. Simply put, if this snapshot looks unhealthy, banks are definitely not going to lend to you.
Let's connect this financial jargon directly back to your clinical reality. When you see current assets, we're talking about cash on hand to fund daily operations, sure, but also inventory, everyday items, dressings, linens, medications. These are current assets because they're consumed to generate revenue. Fixed assets are the big-ticket items, buildings and equipment, which undergo depreciation over time. And the flip side, salaries. Salaries are absolutely the single largest liability for healthcare organizations.
Next up, we have the income statement. This statement summarizes all of your operating revenue and expenses. You start with gross patient revenues, but, and this is a big but, you have to deduct things like bad debt and charitable allowances. What you're left with determines a really crucial indicator, your margin, or percentage of net revenue. If you don't have a positive margin, your organization literally cannot sustain itself.
And rounding out the big 3 is the statement of cash flows. This report is the ultimate tracker of how actual, hard cash moves into and out of the organization. It categorizes everything into operating, investing, and financing activities. See, the income statement might include promised money that hasn't arrived yet, but the cash flow statement, it tells you exactly what is sitting in the bank right this second.
All right, Section 3, the time value of money. Let's talk about long-term planning.
If those financial statements are our vital signs, the time value of money is the science behind our long-term health plan. Let's test your intuition for a second. Suppose I offer you an investment. You give me $1,000 today, and I'll give you $800 1 year from now and another $800 2 years from now. Good investment? You might think, well, 800 plus 800 is 1,600. That's more than 1,000. Of course it's a good deal. But in finance, simply adding those future numbers is the absolutely wrong approach. You cannot just add dollar values from different time periods together.
So why can't we just add them up? Because $1 today is intrinsically worth more than $1 tomorrow. First off, there's the inherent risk of waiting. A lot can go wrong in a year or two. Then you've got inflationary forces and macroeconomic factors just constantly chipping away at the value of currency. The present buying power of your money is simply higher today. So to actually compare these cash flows, we have to pull future dollars back to today's value.
Okay, let's dive into this next part. Section 4, Evaluating Investments Effectively, or how we make those major calls.
Now that we know money changes value over time, let's open up the toolkit that CFOs use to make these massive investment decisions. Let's look at a present value or PV calculation. Say someone promises to repay you $1,000 in 1 year. That's your future value. How much would you lend them today? Well, let's assume a riskless 1% bank CD rate. That 1% is your discount rate. To find the present value, you literally just divide the $1,000 by 1.01, giving you $990.10. This brilliantly illustrates how present value connects future cash flows with today's money, mathematically adjusted for both the weight and the risk.
And once we can calculate that present value, we unlock the ultimate metric, net present value, or NPV. Measured in today's dollars, NPV takes all future cash flows, discounts them back to the present, and subtracts your initial investment. The golden rule? The NPV of an investment must be greater than 0 to produce a real return on investment. If you're looking at multiple choices, you always pick the project with the highest NPV. Any valuation method that disagrees with NPV is, quite frankly, wrong.
That being said, there is a super popular alternative out there called the internal rate of return, or IRR. Instead of dollars, IRR is expressed as a percentage. It's actually the exact discount rate that forces the NPV to 0. It's very intuitive, which is why companies love it. They'll just accept a project if the IRR is greater than their hurdle rate. But here's the catch. If IRR and NPV ever give you conflicting advice, you always trust NPV. Now, to calculate these metrics accurately in the first place, we rely on free cash flow, or FCF. This is the cash a firm has available to distribute after taxes, depreciation, working capital, and capital expenditures. The crucial takeaway here is that free cash flow tells us what actual, tangible cash is left over after we've accounted for non-cash expenses like depreciation. It's the literal lifeblood of your project's financial forecast.
Which brings us to our final act, Section 5, the capital budgeting process.
This is where the magic happens, where we bring the financial vitals and the time value metrics together to inform the organization's overarching strategic plan. When forecasting a capital budget, there are strict rules. You only consider incremental cash flows, money generated specifically because of this new project. You have to ignore sunk costs completely. Don't let past spending sway your future choices. Include your opportunity costs, but never allocate existing overhead to the new project. This brilliantly illustrates how strict financial forecasting forces us to look purely forward using evidence-based assumptions.
All of this feeds right into the 3F framework for project evaluation: finances, fit, and feasibility. We just spent a lot of time on finances, getting that positive NPV. But what about fit? A project might have a beautifully positive financial return, but it absolutely can and should be rejected if it doesn't align with the organization's core vision. And then there's feasibility. Do we literally have the human resources and market viability to pull this whole shebang off? Ultimately, the capital budgeting process is a highly structured journey. It's led by the CFO, derived from strategic initiatives and SWOT analyses, and heavily supported by those 3F elements. It's how we tie massive expenditures directly to mission effectiveness. And the final stamp of approval? That always comes from the governing board.
We have covered a huge amount of ground today, from basic GAAP anatomy to the advanced time value math that drives major healthcare decisions. You now know exactly how to read your organization's financial vital signs. So here's my question for you. Knowing what you know now, are you ready to step up to the table and prescribe a capital budget that ensures your organization's long-term survival? Think about it. Keep questioning, keep learning, and I'll see you in the next explainer.